The median American aged 55 to 64 has $185,000 saved for retirement, according to the Federal Reserve Survey of Consumer Finances. They are going to live approximately 20 to 25 years after they stop working. Do that arithmetic on a cocktail napkin and you get a number that makes your face change. And here is the part the brochures don't mention. There are $49 trillion in American retirement assets right now. Not a guess. That's the Investment Company Institute's own data from year-end 2025. And the industry sitting on top of that number has no structural incentive to point at the simplest possible solution and say, that's the whole game. Because the whole game doesn't require a fee schedule, a managed account, a risk tolerance questionnaire, or anything more exotic than 2 accounts and 1 rule. It requires an expense ratio of 0.03% per year, a money market account paying somewhere between 3.5% and 4% annually right now, and enough discipline to not crack open the wrong account during a crash. In the next 20 minutes, I'm going to walk you through the exact dollar-by-dollar mechanics of this strategy across 3 realistic retirement years, including a year where the market drops 20%, tell you what the actual casualty statistics look like when people do this wrong, and explain why most people who understand this plan intellectually still blow it when it matters. Not because the math is hard, because their brain manufactures a reason to override it at exactly the wrong moment, and understanding why that happens is worth just as much as understanding the strategy itself. Here is what this video is actually about. The retirement strategy I'm going to describe is structurally simple, historically validated, requires no financial advisor, produces better outcomes than most professionally managed approaches over long time horizons, and fails in the real world for one reason that has nothing to do with the strategy itself. It fails because people build the right structure and then abandon it under pressure. The purpose of this video is not to sell you on an idea. The idea is available in any decent financial library. The purpose is to show you the specific numbers, the specific behavioral failure mode, and the specific structural trick that makes rational behavior the path of least resistance rather than an act of willpower. Because willpower under financial stress has about the same half-life as a New Year's resolution. The plan gets called different things in different places. Bucket strategy, cash buffer approach, 2-account system. I'm calling it the 2-tank system because the metaphor is going to do significant work throughout this video, and I want to introduce it cleanly now. You have a cistern, large, mostly underground, the place where real wealth accumulates, and a small tank above ground, the thing you actually drink from every day. In retirement terms, the cistern is your equity position. Something like VTI, the Vanguard Total Stock Market ETF, which has returned an average of 9.51% annually since its inception and costs 0.03% per year to own. 0.03, $3 per year per $10,000 invested. The entire US stock market, roughly 3,500 companies across every sector and market cap in one ticker for less than the cost of a cheap pen. The small tank is a money market account holding roughly 4 years of living expenses. Right now, in early 2026, competitive money market accounts and funds are paying between 3.5% and 4% annually, roughly tracking the federal funds rate, which the Fed held steady at 3.50 to 3.75% at its April 2026 meeting, according to Bankrate's current data. The small tank earns modest returns, the cistern grows, and the entire discipline of this system collapses to one repeating principle that I want you to hear before the math starts. Drink from the small tank. Leave the cistern sealed in the drought. I'll return to that phrase. It does all the work. Before I show you the 3-year number sequence, I need to tell you about Robert. Not because I enjoy cautionary tales, but because Robert is statistically representative of a catastrophic retirement failure pattern that the industry has never fully accounted for, and understanding what happened to him is what makes the 2-tank architecture legible. Robert saved for 30 years. He maxed his 401k consistently. He diversified. He avoided timing the market. He arrived at 62 with $900,000, which, by any realistic reading of the data, is a genuine achievement. The number Americans believe they need to retire comfortably in 2026 hit $1.46 million, according to Kiplinger. Robert wasn't at the magic number, but he was close enough to feel secure. He set up automatic monthly withdrawals of $4,500. a 5% annual draw rate, a shade above the famous 4% rule. Every article he'd read described this as aggressive but defensible. And then 2008 arrived. The S&P 500 dropped 37% in 12 months. Robert kept withdrawing because what was the man supposed to do? Stop eating. He had one account. The one account was the only available water source. By the time markets recovered in 2012, he had been forced to sell shares at depressed prices for 4 consecutive years. He never recovered to where he should have been. He died at 79 with a portfolio that, on any optimistic projection, should have lasted well into his 90s. He wasn't reckless. He wasn't naive. He drank from the cistern in the drought. That's the whole story. Here's the thing you think is the problem with Robert's situation. He withdrew too much. The actual problem is that he withdrew at the wrong time. Those are completely different diagnoses with completely different solutions. Reducing your withdrawal rate from 5% to 4% helps, but it doesn't solve sequence of returns risk. Diversifying into bonds helps, but a 60-40 portfolio still requires regular withdrawals during downturns. The two-tank system doesn't try to reduce cistern volatility. It accepts that the cistern will swing dramatically. That's the price of 9.5% average annual returns. And it creates an independent water source, so the cistern never has to be cracked during the worst market conditions. In a few minutes, I'm going to show you what the math looks like across 3 specific years. And the dollar gap between the two approaches is going to be hard to ignore. But first, there is something the sequence of returns research reveals that I think even well-read financial people miss entirely. A 2024 report from Fidelity confirmed that negative returns are most damaging when they happen early in retirement. What Morningstar portfolio strategist Amy Arnott publicly called the danger zone for withdrawal exposure. The mechanism is what researchers call reverse dollar cost averaging, and it is the inverse of everything that helped you build wealth. When you're accumulating, a market decline means you're buying shares cheaply. When you're withdrawing, a market decline means you're selling shares cheaply. If VTI is priced at $50 per share and you need $4,000 this month, you sell 80 shares. If VTI drops to $40 per share and you still need $4,000, you sell 100 shares. Those 20 extra shares are gone permanently. They don't recover. When the market bounces back, you recover with a smaller base. That gap between what you sell and what you would have sold compounds silently, year over year, until the projection that looked fine on the day you retired looks impossible a decade later. Here is the actual architecture. You retire with $1 million. You need $50,000 per year to live the life you want. $30,000 of that comes from Social Security. Your portfolio needs to produce $20,000 annually. You take $200,000, 20% of the portfolio, and put it into a money market account. At a conservative 3.5% yield, that $200,000 earns $7,000 per year. The remaining $800,000 goes into VTI, 2 accounts. That's the architecture. Write it down. Year 1, the market cooperates. VTI gains 7% on $800,000. That's $56,000 in gains. Your money market earned about $7,000. Combined, you generated $63,000 without touching a cent of principal. You need $50,000 for the year. You take $50,000 from gains, harvest it across both accounts, and your portfolio ends year 1 at essentially $1 million. Principal untouched, cistern sealed. Small tank, full. Drink from the small tank. Year 2, the market drops 20%. VTI falls from $800,000 to $640,000, a paper loss of $160,000. In this exact moment, the average person with a conventional single account withdrawal strategy faces a decision they are neurologically unprepared to make correctly. They watch the balance fall. They call their advisor. The advisor says something reassuring and generic about the long arc of history. They keep withdrawing because they have no alternative. Under the two-tank system, here is what happens with your VTI position in year 2. Nothing. You don't log in. You don't rebalance. You drink from the small tank. Your money market earned approximately $7,000 on its balance. You need about $51,500 for the year. with 3% inflation. You draw about $44,500 from the buffer. Buffer drops to approximately $162,500. VTI stays at $640,000 and begins its quiet recovery. Not a share sold at the bottom. Year 3. VTI bounces 15% from its trough. $640,000 becomes $736,000, $96,000 in gains. You need about $53,000 for the year. You take $53,000 from VTI gains. VTI settles at approximately $683,000. Buffer sits around $167,000, having earned some interest. Total portfolio, approximately $850,000. You have been retired 3 years. Year 2 included a 20% market crash. You have 85% of your starting million intact. Every share you owned at the bottom of the crash is still there. Drink from the small tank. Leave the cistern sealed in the drought. The cistern recovered on its own. By the way, hit subscribe if you like this kind of content. Otherwise, YouTube's algorithm may genuinely never show you my videos again. Now here is where I want to go deeper than most retirement content is willing to go. The psychological architecture of the two-tank system is as important as the financial architecture, and they're actually the same design. The reason you don't sell in year 2 is not that you're disciplined or principled or a rational agent who reads FAMA French papers. The reason you don't sell is that you have 4 years of expenses covered before any of this started. The threat isn't immediate, and the human brain responds completely differently to a threat that's 3 years away versus a threat that's 3 months away. The urgency that drives panic selling, that cortisol response, that almost irresistible need to do something, requires the perception of immediate danger. The small tank removes immediate danger. That's its job. It's not there to earn returns. It's there to give your nervous system something to look at that isn't falling. The data on what happens when retail investors try to navigate market volatility without that buffer is genuinely shocking. Dalbar, the research firm that has tracked investor behavior since 1994, released findings in early 2025 showing that the average equity investor earned 16.54% in 2024. The S&P 500 returned 25.02% in the same year. That is an 848 basis point underperformance gap, the second largest in a decade, in a year when the market went up dramatically. And this wasn't unusual. Average equity investors have now underperformed the S&P 500 for 15 consecutive years. The last time the average investor beat the index was 2009. 15 years of consistent behavioral drag in good markets and bad. Morningstar's separate analysis found that investors in US mutual funds and ETFs over the 10 years through December 2024 earned 7% annually, while the funds themselves returned 8.2%. That 1.2% annual behavior gap represents approximately 15% of total potential returns forfeited. Not because of fees, not because of bad fund selection, because of behavioral decisions driven by emotional responses to short-term volatility. The same $100,000 left untouched in the S&P 500 from 2004 through 2024 grew to $717,000. The average investor making the kind of emotional decisions Dalbar documents annually ended the same period with $345,000. More than half the wealth destroyed by the investor's own response to their portfolio. This is where I want to bring in a subplot I've been threading through this video, because it connects the behavioral data to something concrete. A man I'm going to call Marcus retired in February of 2020 with what he called, on a financial planning forum, a modified cash-first approach that he had adopted almost accidentally. He didn't trust the market, so he kept a large cash reserve, roughly 4 years of expenses, because it helped him sleep. He didn't think of himself as disciplined. He didn't think of himself as having a system. He had a buffer, and he kept it because the alternative felt frightening. On February 19th, 2020, the S&P 500 began what would become a 34% decline in 33 trading days, the fastest crash in recorded market history to that point, according to market data. And Marcus, by his own account, forgot to check his brokerage account for 6 consecutive weeks. He was living off his cash buffer. He had no reason to look. When he finally did check, the recovery was already months underway. He never sold a share at the bottom. He made no tactical genius call. He had a buffer, and the buffer made him boring at exactly the right moment. Being boring at the right moment is worth more than being intelligent at the wrong one. Remember that for the end of this video. Here is the opportunity cost objection, and I want to address it directly because it's the only genuinely serious counterargument to this structure. $200,000 in a money market at 3.75% earns about $7,500 per year. $200,000 in VTI, earning its historical average of 9.5%, earns about $19,000 per year. The gap is roughly $11,500 annually. Over 20 years of retirement with compounding, that is a real and non-trivial number. Anyone who tells you the opportunity cost of this cash buffer is negligible is not being straight with you. The honest accounting is that the two-tank system deliberately sacrifices some long-run theoretical return in exchange for behavioral stability. And the reason that trade is favorable, overwhelmingly favorable, is the Dow bar data. The hypothetical model that shows the fully invested portfolio slightly outperforming the two-tank system assumes you behave like a model, not like a person. The 15-year consecutive underperformance streak tells you how that assumption fares in practice. The two-tank system costs you some upside in the optimistic scenario. It protects you from yourself in the realistic scenario. Now, let me give you a more granular breakdown of where you might actually be. I think of this as 3 levels, and where you are determines how to apply this. Level 1, you're within 5 years of retirement with a meaningful portfolio, 400,000 or more. The two-tank architecture is applicable to your situation right now, before you stop working. The most important thing you can do in the next few years is set up this structure and then watch the market drop 10 or 15% without touching your equity position. Not because a correction is coming though, in a 20 to 30 year retirement. Multiple corrections are essentially guaranteed, but because the habit of leaving equity alone during a drawdown is a skill, not an intention. Skills require practice. If the first time you're asked to leave your equity position untouched during a downturn is 6 months into retirement when you're fully dependent on the portfolio, you're doing the hardest practice rep at the highest stakes moment. Do your reps first. Level 2, 10 to 15 years out. The two-tank retirement structure isn't your current form, but this is your most important training period. Every time the market corrects 8 or 10%, and that's happened in 14 of the last 20 years. At least once you're getting a low-stakes practice opportunity. The emotional pull to move to cash, to wait for clarity, to do something with a falling number, that pull is training material. Treat every correction as a dress rehearsal. The people who execute the two-tank system well in retirement spent the previous decade learning to treat market volatility like weather. You get an umbrella. You don't try to negotiate with the rain. Level 3, further out. Retirement feels abstract. The relevant version of the same principle is simpler but identical in structure. Maintain 6 to 12 months of expenses in cash or near cash, completely separate from any investment account. Not because you're pessimistic, not because you think a crash is coming, but because a buffer prevents forced liquidation. Forced liquidation, being compelled to sell investments because you don't have liquid cash to handle a medical bill, a job loss, an emergency, is by a significant margin the most wealth-destroying behavioral event I've observed up close. Worse than fees, worse than bad fund picks, worse than any market timing decision. When life forces you to sell at a bad moment, you lock in losses and interrupt compounding that would have made you comfortable over time. The buffer is not a fear hedge. The buffer is what makes you a rational actor. Without it, you're a market participant with feelings and an urgent need for cash. That combination is expensive. Let me now make this concrete at a scale that might feel more like your actual situation. Patricia is 64, just retired, $500,000 saved. Social Security covers $30,000 per year. She needs $25,000 from her portfolio annually, a 5% portfolio draw rate, which sounds aggressive but reflects the reality that Social Security is covering the majority of her spending. She takes $100,000 4 years of her portfolio's required income into a money market. The remaining $400,000 goes into VTI. Year 1, VTI gains 6% on $400,000, $24,000. Money market earns about $3,700. Combined, $27,700. She needs $25,000. Takes it from gains, doesn't touch principal. VTI stays at $400,000, buffer stays at $100,000. Year 2, market drops 20%. VTI falls to $320,000. Patricia draws from the buffer. Buffer drops to about $78,000 after her withdrawal, and a small amount of interest. Here's the number that matters. $78,000 divided by approximately $25,000 per year means Patricia has over 3 years of portfolio income covered without needing to touch her equity position. That is her psychological runway. She is not watching a crashing brokerage account while calculating months of expenses remaining. She's watching a money market account declining slowly and predictably, while her equity position quietly absorbs the crash and waits. Her decision-making environment is structurally different from Robert's. Year 3, VTI recovers 12% from its trough. $320,000 grows to $358,400. Patricia takes approximately $25,750 from gains. VTI settles around $332,650. Buffer, with some interest accrual, sits around $81,000 total portfolio, $413,650. She has been retired 3 years, survived a 20% crash, and retained over 82% of her starting $500,000. No financial advisor, no tactical genius, a money market account, and 1 index fund. The cistern recovered on its own. She never had to crack it in the drought. Patricia's outcome wasn't determined by picking the right fund. The performance difference between VTI and VOO, the Vanguard S&P 500 ETF, over the past decade was fractions of a percentage point. Fractions. Patricia spent 3 weeks researching that fund choice. The fund choice was essentially irrelevant. The structural choice, the cash buffer, the separation of the small tank from the cistern was everything. This is what behavioral finance researchers call financial displacement. Putting analytical energy into a decision that feels rigorous but has low actual impact, to avoid confronting the harder behavioral question that has enormous impact. The harder question is, when it's down 30% and financial media is catastrophizing and your neighbor is panic selling, can you leave the cistern sealed? The answer for most people without a structural system enforcing that behavior is no. That's not a character flaw. Loss aversion, the psychological phenomenon where losing $50 feels roughly twice as painful as gaining $50 feels pleasurable, is a documented feature of human cognition. The two-tank system doesn't fix your brain. It builds a fence around the decision. Now Marcus comes back. He retired in February 2020 with a 4-year cash buffer he'd accumulated, half by design and half because he was nervous. The fastest market crash in history unfolded around him over 33 days. He forgot to check his brokerage for 6 weeks because he had no reason to. When he did look, the recovery was underway. Robert had 1 tank, Marcus had 2. Same crash, same market, same period. Robert was forced to sell at the bottom for years. Marcus never sold a share. The only structural difference between their outcomes was a money market account. Not intelligence, not discipline, not insider knowledge. A small tank. 3 practical things I want you to do with this. First, calculate your actual annual portfolio withdrawal number. Not your total spending, the specific dollar amount your portfolio needs to generate after Social Security, pension, rental income, or any other income source. That number determines everything. 4 times that number is your small tank. Everything else is your big tank. Most people have never isolated this figure with precision, and the vagueness is its own kind of problem. You cannot build a buffer against an unknown. Second, write down in advance, in specific pre-committed language, the exact conditions under which you will transfer money from your equity position to your cash buffer. Something like, I will move money from VTI to my money market when VTI is positive year over year and my buffer has dropped below 2 years of portfolio income. That specific pre-committed decision rule is the only mechanism I've encountered that reliably overrides emotional decision-making in real time. Without the rule written down before the crisis, you will negotiate with yourself during the crisis. And the version of you that's scared at midnight watching a bear market will win that negotiation every time. The rule short circuits the negotiation because there's nothing to deliberate about. The conditions are either met or they aren't. Third, do not optimize the wrong variable. The instrument choice, VTI versus VOO, a 2-fund portfolio versus a 3-fund, dividend focus versus total market, matters far less than the behavioral structure. The Morningstar behavior gap data shows that the average investor in US funds forfeited 15% of total potential returns over the past decade through behavioral decisions alone. That is not a fee problem. That is a structure problem. Get the structure right first. Pick something broad, diversified, and cheap with an expense ratio under 20 basis points, and then stop analyzing it. The system does the work. The instrument barely matters compared to the discipline of keeping the cistern sealed in the drought. I've had multiple hundreds of thousands of dollars invested through real market cycles. I've watched the pattern repeat with boring predictability. The investors who build and preserve wealth are almost always the most boring people in the room. They're not the ones with the most complex thesis. They're not the ones who caught the bottom in 2020 or rotated into energy in 2022. They're the ones who set up a simple structure, funded it adequately, and did approximately nothing during every crisis that followed. That's the whole profile. Simple structure, adequate cash buffer, disciplined inaction during volatility. The outcome is not spectacular. Patricia's story is not one she'll be telling at parties, but it is survivable, repeatable, and psychologically sustainable across a 20 or 30-year retirement. In a country where 54% of American households have no dedicated retirement savings at all, according to the Federal Reserve's own data, boring and functional is a remarkable and underrated outcome. Lazy investing built more fortune than crypto memes. And if part of you is still waiting for the hidden insight, the signal, the sector rotation, the proprietary read on where rates are going in a midterm election year, I understand the expectation. The financial internet rewards complexity. Complexity feels like research, but the evidence on whether complexity generates better retirement outcomes is unambiguous. Dalbar has tracked it for 30 years. The average investor consistently underperforms the boring strategy, 15 consecutive years. The system I just described costs 0.03% per year and writes on a napkin. That's not a limitation. That's the design. The people who internalize this are the ones now watching their grandkids grow up without checking brokerage balances every morning. They found out that the easiest retirement plan there is was also the only one they actually needed. The cistern recovered on its own. It always